Hello everyone, I'm Lynette Zang and welcome to ITM Trading. I had a very wonderful visit with Rob Kientz, who is a contributor for Seeking Alpha. But he's also an author of the book Drop Shadow, The Truth About the Economy. He's the founder of Gold Silver Pros at goldsilverpros.com. He has over 20 years working with the technology sector in both IT and in security, which means he knows what to look for when things look right and when they don't look right. He's really quite a talented analyst. He began his investment career about 16 years ago and was fully licensed as both a stockbroker as well as an insurance agent. So he understands those contracts and how to read them. And he also understands the perception management that they use to get you to go along when you don't really understand what it is that you're looking at. He began analyzing precious metals over 10 years ago as a result of what happened in 2007 and 8 and in the process of doing his research for his book. He made a very special trip out here so that he and I could sit down on a one-on-one discussion. And I have to tell you, this was an amazing discussion where we really covered quite a bit. We looked at, again, the perception management, which is so key in your ability to make educated choices. We talked about how central banks use gold and the probability of a gold and or silver confiscation, and frankly, the difference between your bullion as well as your collectible coins and where they would fit inside of a portfolio. But he's been accumulating metals for quite a number of years. And as an analyst, as somebody that understands the inner workings of the markets, who's researched them extensively, he changed the strategy that he was using to accumulate gold and silver and follow the strategy that I created based upon my repeatable studies that he learned here at ITM Trading. It was a fantastic discussion. That's why we're publishing it today, because you need to know the things that we talked about. And I think you're really going to get a lot out of it. So, without further ado, here's that discussion. Enjoy.
So we were talking earlier today that there has been some big stuff going on in the markets.
Huge.
And we were talking about volume. So maybe you could talk a little bit about volume and what you're seeing.
Yeah, well, for those readers or viewers that are not familiar with this, I pay a lot of attention to the volume of trades on the exchange. Mm-hmm. And when you see prices going up, which is what we've seen since 2010, you've seen prices going up as volume has gone down. That indicates that there's some kind of manipulation tool, because in a normal free market, when demand exceeds supply, mm-hmm. prices go up, and when supply exceeds demand, prices go down. And that's not what we've been seeing since 2008.
Right.
So what we've been experiencing really since January, as the markets have been roiling, and more specifically since October, is the markets imploding under their own overvalued weight, because the buyers just have not shown up to the market. Mm-hmm. So my concern for most people, well, for everybody that's in the markets, for everybody, frankly, is that when there is an influx of selling, mm-hmm. that's when the lack of buyers, that lack of liquidity in the market will become brutally apparent, like last week when the CME had to halt trading over 40 times because of the lack of liquidity in the markets. Mm-hmm. That if that's where you're holding your wealth, you're not getting out. Mm-hmm. I mean, it is that simple. It's the bail-in.
So it's much like when there's a bank run and people can't get their money out of the banks. They'll have a bank holiday, or they'll go to the bank, and what will happen is they'll only let you have a little bit amount of money, or they'll let you have what's in the ATM, and once that runs out, there's no more money.
Right. And you know, you made a comment about the bank holiday. Well, when they shut the markets last Wednesday, or I think that was on the 6th or something like that. I'm not sure, whatever day that was. They shut the markets. That was not a planned event. That was a way to calm the markets down. So you don't even realize that they actually went on a bank holiday. Okay, they used a different excuse, but it was about, you know, putting a speed bump in the rapid decline in the markets.
And the volatility, I think, has really kicked up since October. And I was doing a bunch of videos on this on my YouTube channel about look at the volatility in October. And I thought leading into Thanksgiving it would slow down a little bit, because that's typically what happens. It typically calms down before the holiday, and we come back and we get the retail sales numbers. And so I was looking at the market from a traditional point of view, but then that volatility came back after Thanksgiving and really hasn't stopped.
Well, you know, the interesting thing about the volatility is when you have a lack of buyers and you have that lack of liquidity in the market, it takes less volume to create that volatility. Right?
Less traders, so any move that happens is going to have a bigger effect on the market.
Voila, exactly.
Because there's not that normal base of buyers that will smooth out those transactions. So if a big mover comes in and they're either buying or selling, you're going to see that big pump up, or you're going to see that drop down.
Exactly. Yeah. And see, the ETFs, which are actually derivatives, and people don't really realize this, but we've basically had the rise in ETFs since the CDO derivatives were killed. Well, they weren't killed, but they were mortally wounded because they're living again. But the CDO derivatives on mortgages, when that trade busted in 2008, then we saw the rise of the ETFs, which is another derivative form, right? Derived from the underlying whatever it is, but it doesn't have any relationship to it. And the big key about the ETFs is most of them, by a wide margin, most of them do not hold any cash. So they're created when people buy them, and they are destroyed when people sell them. But nobody can access the underlying unless you are an authorized participant. So one of the banks, like JP Morgan or Merrill Lynch or any of those guys, right? And because ETFs do not pay out in cash, they pay out in kind, which means that they can either pay them back in other shares of derivatives, so a derivative for a derivative, or if it happens to be an index fund, and if they happen to actually electronically anyway hold the underlying shares, they can give them those shares. So all the Apple stock with Apple in a bear market, okay, it would be a whole lot worse, because I'm not seeing a huge spike, though, and this made me say, holy crap, it's not pervasive yet, so I'm not fully prepared to put my neck on the line, but it does definitely appear like that volume shift is in process right now. And so when you get this massive influx of sellers into the markets, and there are no buyers on the other side, number one, you have a huge price dislocation, right? Hence the flash crashes, right? And number two, you're not getting out, period, because they'll shut down the markets just like they did last week.
So explain a little bit about what the insiders have been doing the last couple of years with their shares, because I know there's been an explosion in corporate debt. We're at the highest levels of corporate debt that we've ever been in history. And when I go to analyze a company, a lot of times I'll see this explosion in debt, and then I'll see a corresponding share buyback program. And it seems as though what they're doing is they're using that debt to not only pump up the share price, but for large holders of those shares to get out of the market. whether they're the owners of the company or whether they're the large shareholder, large investors or funds or whatever the case may be. So what have the insiders been doing with those funds, and are they out of the market yet to where they feel comfortable where this volume shift happens that they're not going to be taking any risk, or do you still see risk with the insiders as well?
That's really the big question. But what we've been witnessing is typical prior to every financial crisis, where the elites, those that understand what's actually going on in the corporations, are liquidating. And once, I think it was 2003, once they said that the corporations couldn't be held liable for manipulations by doing the share buybacks, that's when that really ratcheted up and enabled those at the top of the heap to take their chips off the table while they're pushing the shares up. And who's left? Oh, let's see. Oh, that's the institutional investors. So that's the institutions invest the money that you put into your 401k and the money that's in the pension plans and the variable annuities. So, we've seen that hugely. Interestingly enough, I just did a piece on an update, really, or it started out to be an update anyway, it got bigger than that, but an update on where we were in the real estate market. Now, specifically, since you're talking about insiders, I looked at Toll Brothers, because the guys in the back, and Tom. Okay, so I looked at Toll Brothers. Interestingly enough, I mean, that stock is definitely in bear market territory, but Robert Toll, who is the most senior chairman in the corporation, has actually been selling out massively over the last specifically 12 months. So he's gotten out a lot of his shares at most likely a much higher level than right now, announcing in August how great things were and how there was so much demand for the higher priced homes. And he sees demands coming from which group? Oh, millennials. The average price of their house is what, $852,000. Now, you really see a whole lot of millennials that have the ability to support that level of real estate?
Absolutely not, because they have almost a 50% unemployment rate getting out of college, and if they do get jobs, they're not getting jobs in their field and at the income level that they're expecting. So a lot of them are still living at home. They have this debt that they have to pay off without that income to pay it, and so they don't have the discretionary income to get into these houses. And we see the real estate market with the houses being as expensive as they are right now, it's really at a top, where it's been for a very, very long time. And so they're not able to buy at this level. In fact, I was watching HGTV last night as I came into Phoenix, and the show was about this couple in Los Angeles that was trying to buy a home. And they're like, the top that we want to spend is $650,000, and they could not find a single property that would fit in their budget, so they had to go up to $800,000. Well, now they've just locked themselves into this lifetime of debt at this home, which is very likely never to appreciate, or at least not to appreciate in the short term. They're going to take a hit on their prices over the next couple of years as the real estate prices come down. And that's a really scary proposition. So it's not really conducive to the millennials being able to build wealth over time. It's really they're losing wealth. As soon as they get into these contracts, then they've got this payment that they have to make to keep their home, and it's going to become a point where they're very frantic to make those payments as they run out of income. And I just see a situation where that's not going to be very positive for them.
Exactly.
And it's not going to be the same situation, we had growing up, where we had the ability to buy a home and be in that home and then sell it later on and have a little bit of wealth in that home and then maybe move to a bigger home or retire off of those proceeds. Or a lot of what you see people doing today, doing those reverse mortgages and taking the equity out of their homes that they built up over time. I don't see that happening for the millennials, and so it's just it's a tough situation.
It's a very tough situation because the whole financial system has to shift. And if you have 70% of the GDP based upon consumers shopping, and you've got 20% of the GDP, at least in this country, based upon real estate, and what happens when they buy those homes at that higher price and then they go down, they don't want to put more money into them to fix them up.
No.
So we have a similar kind of circumstance that we had in 2008, except that home ownership is down a lot from 2008 because a lot of the homes when they were at bargain basement levels, they went to a lot of those same guys that caused the crash and reflated the trade. So it's rinse, fold, wash,
Right.
Over and over and over again. When are we going to learn?
It becomes a wealth transfer mechanism to the people
100%.
that have that are the lenders. The lenders in society, during those times are the ones that make out. And it was interesting because I was working, doing an engagement. I was in consulting. I was doing an engagement for a large bank, and it was a rather large engagement where they wanted us to help them process a lot of loans during 2008. It was a defunct mortgage lender. And so I got to see a lot of the data from the inside because we were building out a business process for them to service these new loans. There were a lot of issues with the loans that we had to sort of sort out. But that was really my first introduction to the inside on the real estate market. And it was just very interesting to see how that really worked. And then I got in later on into getting into REOs and other parts of real estate. And it's just, it's one of those things where if you're looking to build wealth, real estate really is not the place to be right now, and I don't think the stock market is either. The valuations are so high, so there may be better alternatives to get into.
You always want to look. In my personal opinion, I think it's critically important for people to understand how to identify three key things. Mm-hmm. Number one, what is the fundamental value or the true value of that asset or that instrument? Mm-hmm. And it can't be your personal opinion. You've got to figure out, number one, what the most important function of that asset or instrument was to whoever created it. Yeah. And then you take a look at, how has history valued that? Mm-hmm. When we needed to have money so we could diversify the economy, the most important function of that money was a way to value labor, mm-hmm, and hold any excess labor that you didn't need to use today for the future use, and we wanted it to maintain its value, so you were always paid fairly for your labor. Mm-hmm. This is not rocket science. Right? They tried lots of things, but only gold actually meets every bit of the criteria to be a good money. And, silver is secondarily, and I love silver too. I think you need mm-hmm both. But they're both physical. And the thing about those metals, not only does it take labor and energy to pull them out of the ground and process them, mm-hmm, but in gold's case in particular, it's indestructible. And in both of those cases, they have properties that they've never been able to duplicate in a lab. So there's global demand. Sometimes more, sometimes less, depending upon where the economy is, but there's always demand. Mm-hmm. And its most important function was to hold the value over time. Mm-hmm. It's the most important function. It's easy.
Yes.
Fiat money is just the opposite. Its most important function, when you read the documentation, John Maynard Keynes, when they set things up, it was inflation, which would create nominal confusion, mm-hmm, so that its value, ultimately, every fiat money goes to zero.
Yes, and the U.S. dollar is at 98% discount now to what it was in 1913 when they started it. And a lot of that is something I wrote in my book as well. I basically showed a table of the value of the dollar over time, measured in inflation. And even going back pre-1913, I looked at gold all going back to the start of the Republic. And it's interesting to note that gold holds its value over time in that same time period where the fiat currencies don't.
Right.
And it's also interesting to note that it really doesn't bubble up a lot, reach these high bubble valuations like real estate does, and like a lot of these derivatives do, these paper contracts in the stock markets and things. So it tends to hold its value more over time. So I think if you're trying to hold value over time, gold is really a better place to put your money than a house. And I think that millennials right now are learning that, to get back to our earlier conversation.
Right.
And a lot of people, are learning that as well. And you even see that in television where they're doing the house hunter show, mm-hmm, and people are going out saying, I can't find a house in my budget. Everything's overpriced. That's the sign of a bubble, but that bubble has to come back down, because when you have houses priced so high people can't buy them, it's supply and demand. The price is going to come back down, and then at some point in time it's going to lose value. So homes, even though we traditionally have thought of them as stores of value, are not really stores of value over long periods of time like gold and silver are. And I can speak to that personally because I ran a real estate business in Dallas-Fort Worth for 17 years, and I held a lot of them long-term as rental properties. And I saw this bubble coming in the market, and that's why I sold out in 2017. Because I could see very clearly that you could see that there were more renters, which is good for somebody renting property. But what's bad is if I'm holding these properties, I could be left holding the bag if the values come down to a certain point where they don't hold their value, where I can't resell them. And not only that, when you can't resell them, the rents also have to shift back down. So even though we're having really good rent levels now for a lot of the real estate investors, that has to come down to meet the market as well, because people can't, if they can't afford the rents have to come down.
Exactly.
So I think a lot of people put their money into their homes and thinking that's a long-term asset, and to some extent it is if you do it within the frame of which you're in the bull market.
Right. And you have to have a place to live.
Right.
Right? And you have to have, I mean, where we are in the cycle right now, you have to have a way to sustain your standard of living. So, owning property, and we're going to go to the farm later, but, owning property enables you to then go ahead and create food and security and all these other things that we need. So I don't think you're saying that you shouldn't have a house.
No, absolutely not.
No.
There's always going to be a floor under that value. Yeah.
Right. Because it's still a tangible asset.
Yes.
At the same time, the REITs and the products that Wall Street has created, the derivative products, these ETFs, well, they're going up. But it was, I'm pretty sure it was, it was March of this year is when we saw peak valuations, and the value of the houses of the real estate markets. This started in other places before that, but overall has started to come down since March of this year. So what you're talking about is already occurring, but Wall Street product don't reflect that. So if you open up your statement, you go, oh, see, real estate's doing great.
Right.
Right?
But that's a derivative. That's not the actual underlying fundamentals of the market itself.
And the derivative does not have to reflect the net asset value of the underlying assets, presuming there actually are, because they could just be other derivatives. In most of the case, they are. It's leverage upon leverage upon leverage. And that's how wealth just evaporates. That's a wealth transfer mechanism. Absolutely. Whereas when you have a piece of gold or silver physical in your possession, you run no counterparty risk. And while its price in terms of fiat is going to move within a range, there's always demand. So a lot of times, people think that you can have like any gold, and you can, but I've done studies on the laws on the books pertaining to gold confiscation. Yeah. And I can't guarantee one way or the other whether or not the governments are going to do an overt confiscation. And I say that because all of this price manipulation with the derivative products is absolutely, and the inflation, absolutely positively a confiscation of wealth since the day you were born. So it's hard for me to imagine, and plus when you look around, that, they're going to get to this level and then go, oh no, we don't want to take the gold away from the public. You've got the central bankers buying at the fastest level since 2015, which is when the system, the current peg system started breaking down in 2015. And so I always have to ask myself the question, and I think everybody needs to ask this question of any of the choices or any of the planning that they're doing. What if I'm right, and what if I'm wrong?
Right.
Okay? If you own bullion, and I have in the past because it's got a function, and if that's what I was trying to accomplish, but I don't anymore. Since we entered the final phase of this, I liquidated all of that and converted it into collectibles. Because, first of all, in my opinion, and also technically, they are the most undervalued asset in an already severely undervalued asset class that is in a long-term positive trend, because the dollar and all other fiat currencies are clearly in a long-term negative trend. So you don't even have to be a technician to get, that simple piece.
Right.
But because that is truly a physical only market, And they're using perception management to keep people away from gold while they're buying it at the highest level since 2015, and since certainly after the crash of 2008. Right? So do what I say and not what I do. But the collectible coins are the deep, in my opinion, the absolute steepest bargain in what is already a ridiculous bargain asset class. And the reason why I personally accumulate those versus the bullion is because of that right and wrong, scenario. I want to absolutely get, I mean, there are no guarantees, but I want to get as close to a guarantee as possible as I can that I'm going to have the kind of gold that I'm going to have the ability to actually utilize through this trend cycle.
So let's talk about the different types of gold. So I think you've touched on a couple of different ones. Let's first talk about the derivatives, because a lot of the people that, when I'm writing for Seeking Alpha and they're talking about gold, they're really talking about the derivative. And so
GLD and SLV, those kinds of things.
And all of their technical analysis and charting is on that gold price, and maybe not necessarily
the spot market.
Yeah, the spot market, which is created,
a derivative.
Which is a derivative, and it's created basically to regulate the price of gold and silver on a global basis, which allows different parties to control its price for its purposes. We know that China was using the SDR and the dollar peg to help control the gold price for a while. We know that the central banks in the West have been doing that as well. So the spot price is very much a control price, and you can see that in the markets. I mean, it's obvious.
Yeah, it is very obvious.
So those derivatives that people are trading in that has this manipulated, or I would say manipulated may not be the best word. I would say maybe controlled price, like a range controlled price.
Okay, I'd say it's probably both.
Yeah. So people that are investing in that type of product, what are the risks there in owning that type of product, and when do you think that we may see those risks actually manifest?
Well, I think we're close to seeing the risk manifest, and actually, if you bought or converted your fiat money into fiat, GLD, SLV, any of those, most of those gold ETFs, all you own are shares of a trust. You don't own the underlying assets. Okay. But that's a way for the banks to actually control more of the physical gold and silver and get paid to do it. But yet they are the only participants that could actually convert shares into the physical gold and silver underlying. If you bought those shares, you are not big enough to do that. Okay. So it's not what you think it is if you think you own gold. It is not what you think it is. And the biggest risk that you're running is that you don't actually own any gold. And if that's how you're going to hold gold, then you've done nothing.
So there's two main risks there. There's the risk that they don't fund those ETFs with enough gold one for one per all the contracts they're writing for the money coming in.
Well, they don't.
And secondly, you don't, even if there were, you're more of a beneficial owner in the interest of that fund rather than an owner in the underlying asset of the gold and silver itself. So should you ever want to actually redeem for actual gold and silver, you don't have the right to do that. There's not a legal right in order to do that.
Exactly. Okay. In fact, you're blocked from doing it. And it isn't whether or not the ETF or the trust holds a certain amount of gold. What they do, and they say it in all the prospectuses, is that they sell off their holdings to pay the ongoing daily accumulating fees. And since the shares do not have to trade at the value of the underlying, so even the manipulated or controlled spot market, right, which is all that those things are about, is reflecting that. That's what that's about. Even that, you could be and are most likely paying more for it than even the underlying instrument that it's created from.
Right.
Did that make? I mean, when you stop and think about it logically, you just go like, whoa.
So you see something similar dynamic going on with the central bank. So I've looked at a lot of the Fed meeting notes, and I've looked at recently there was a European central banker who was talking about this also. The central banks treat gold as a tier 1 asset, so they
Right.
very much feel as though it's an underpinning of the financial system. In
It
fact,
is.
it's one of the things that underpins all of the currencies,
Mm-hmm.
and a lot of times people don't really recognize that the gold and the gold that the central banks are holding really are underpinning the value of that currency. But what they do is they lease it out to pay the storage fees. They've admitted to doing this many, many times. And so if you look at the amount of gold that you think a particular central bank has, it could be quite a bit less. They may have leased it all out or a big portion of it out.
Right. It's so opaque, you'll never know.
Yeah, and they're not very transparent. But recently there were European central bankers who were asked this question, and this video is online for anybody who wants to view it. And they said, yeah, we constantly lease out our gold to pay the storage fees. So it's not an accumulative thing, it's really supply destruction. And if they're putting that out in the market and there's all of a sudden a big demand for gold, they may not be able to get it back because they don't physically hold on to it.
They aren't.
So the whole point for
They're
this
getting it
is
back, yeah.
because gold is supporting these currencies, but they're leasing it out, they don't actually have the gold that they say that they do. From a national perspective, when we say the U.S. has 8,000 tons of gold to support our financial system, we may not really. And people shouldn't really count on that to support the dollar and our way of life. They should really look to protect themselves.
You know, I don't know that any central banker talks about gold to support the underlying currency.
Mm-hmm.
I did this a while ago.
Yeah.
Because when they do a reset of the currency, they revalue the fiat, which has no intrinsic value. It's only used in one place.
It's paper.
Against the physical gold. And even though right now we're probably getting pretty close to, at a minimum, 10,000 an ounce, and with spots at like 14 something. Okay, so it's severely undervalued. When I looked at it just in relation to the U.S., you know, debt versus the amount of gold that they say that they have, just even assuming that that's accurate for a minute, because we're not going to know one way or the other.
Well, it hasn't been audited since the 1950s, so it's 60 years of no audits. And as a former auditor, I can tell you from experience, if you don't audit something for 60 years, you have absolutely zero assurance that it's actually what they say it is.
Exactly.
Yeah.
But let's assume for a moment, we'll give them the benefit of the doubt. We'll give them the at that time when I thought that the value of gold in my calculations globally was something like, I don't know, 8,500 or 8,000, something like that.
Yep.
If it were just the U.S., and I could be wrong because obviously I'm not looking at it, but I think it was something like over 56,000 an ounce. If it was just based upon the U.S. debt, so the money they've created, and the amount of gold that they hold.
Right.
And the amount of gold that they say that they hold hasn't changed since the 50s either. Not a 16th of an ounce.
They're not accumulating over what they previously said that they had. And we know that they've been leasing out, so it has to be some number below what they've reported, but we don't know.
If they have any.
Right.
You know, and we're never going to know that. I don't think we're ever going to know that.
No.
You know,
Well,
even though Steve Mnuchin went, oh, see, here's a gold bar. We have the gold.
Yeah.
Okay, then, fine. Okay, I'll relax. It's fine. I trust you. Not.
Well, they don't want to say it because if they say it, then it creates this lack of confidence in the system. So even though we're not on a gold standard, people still understand that gold really is part of the value that supports the system. And if they come out and say we don't have the gold, then people are going to panic because they're like, what's backing up our dollar? Because people know that there have been so many dollars created that they know intrinsically it doesn't have value, and they're just trading it, but they know that there has to be something else behind it.
Right.
And if that gold is not there, then in my mind, if they ever came out and announced that they didn't have the gold, it will collapse the dollar just immediately.
So let's look at that a second in terms of the most likely outcome into this next crisis, where we've got the liquidity crunch and we're resetting the entire financial system.
Okay.
And the central banks, I mean, honestly, do they have the gold that they say they have? Probably not, which is why they are more likely to do an overt confiscation of it.
Right. They're going to need it, so they may confiscate it from the citizens who have it. They may nationalize some gold mines and take the gold that way and then just produce it and it basically goes directly into the reserves. So this is a risk also with the mining shares.
Yes.
Depending on what district you own it in, but not only that, not only the existing laws, and I want to make this clear, even if there are existing laws protecting the miners in the country you're in, if that particular country has steep financial issues, they can change those laws. And all of a sudden they can take those assets out of the ground from the miners and say, we're nationalizing this and we're taking it for ourselves. If you're a shareholder in one of those companies, what does that risk, present to you? What do you think could possibly happen in that case? If you own a lot of shares in a mining company and the mines in which you're in, whether it's Mexico or the U.S. or Peru or wherever, what happens to that value of that share? Does it?
Well, there's two questions in there.
Yeah.
Okay, because number one, the value that you see on the screen would decline very rapidly.
Right.
But it's the value. All you can do is convert those shares of stock into dollars.
Mm-hmm.
And the dollar, what are they going to do? There's only one way to fight deflation. And Draghi brought up the specter of stagflation yesterday, right? So that means this next round is hyperinflation. And it was, I think it was April of this year. I could be off, but I'll be pretty close. I believe it was April of this year when we saw the monetary velocity of the M2 supply, so the speed at which money is changing hands, start to turn up. And it hasn't pulled back down yet. So even though I'm not prepared to say that it's pervasive yet, I think that it's quite likely, kind of like the same thing with the volume that I'm seeing on the exchanges. It's now increasing, though I wouldn't go to the pervasive level. However, it is certainly an indication that we have entered a different part of this trend, and a much scarier part.
Yeah, and I think it's the snake eating its own tail, because if we go back to the beginning part of our conversation, we were talking about corporate debt. It's something I brought up. We only have about 1.6 trillion if you look at Fred, which is the Fed's website on monetary data.
My favorite site.
Yeah, I know you
If
spent
you
a lot of
haven't
time
been
there.
on there, you need to go.
So there's 1.6 trillion of available actual printed currency. There is over 3.4 trillion of foreign debt and U.S. denominated debt, sorry. And then we have multiple trillions in the U.S. as well. So that's sort of creating this demand for the physical dollars to pay off that debt. And because they took on so much debt and blew up the system, they blew up the values of the stock market and the companies. Now that debt is starting to come due, it's starting to grab for those dollars. And I did a video just on this, and it's creating what I call a melt up, because the dollar relative to other currencies is being demanded more, so that index value goes up, even though the fundamentals of the dollar are actually coming down.
Exactly.
So if you just look at the dollar index, you look at that and say the dollar's better than every other currency.
Right.
We have a strong dollar, This is what Trump says, but what's really happening is it's being demanded so much that eventually it's not going to exist. And when you have a deflationary situation, they're going to have to bring out the helicopters and start printing, and that's where you're going to see the hyperinflation. And so, to add one more point to that, a lot of people say that we're heading into stagflation, much like Japan had for a couple of decades, and I argue against that, because Japan existed because of the rest of the world would allowed it, would finance that stagflation. But if the rest of the world is now going into the same situation, who is then going to finance that stagflation? So I don't think we're going to have it. I think we're actually going to have a deflationary depression, and then they're going to bring out the helicopters, and it's going to be hyperinflation of the dollar. And at that point in time...
And every other currency, too.
And every other currency. It's worldwide.
Right, it is global.
And so at that time, if you have everything in either currency or currency-denominated assets, you're going to take a big... I don't even think we can call it a haircut. I think you're going to chop it. Oh, no,
it's not a haircut.
Yeah, it's like you're chopping down the tree, right?
Exactly. Yes. This is going to be way more than... this is going to be wealth transferred at a magnitude that we will never see again in our lifetime.
Right.
It really is that simple. But then also going back to the gold issue, because of that, I think that they're going to have to do an overt confiscation. So, I've had people say to me, well, then, why buy gold? Well, you want to buy the kind of gold that is the least likely to be confiscated. Well, how do you know what that is? Well, you look at the elites and what they are doing for themselves. If I could have the retirement plan and the healthcare plan that the federal government has for themselves, I'd be happy. Instead, I have Social Security and Obamacare, right? But I would pay a premium to have that level of care.
Sure.
Gold is the same way. You can have bullion, and that's what the central banks are accumulating. But of course, they're going to write the laws and the rules to support them. What are the elite? Those guys that could really do it in any way they wanted to, but the ones that have either the ability to write the laws, or if they don't write the laws, the ability to influence those that write the laws. And you can see it in the ultra rarity index, where those coins start at hundreds of thousands and millions of dollars, and who can afford that?
That's where the rich people store their wealth, because if they bought a bunch of bullion, there probably wouldn't be enough of it at the current depressed prices, and they'd probably also break the control mechanism for gold, which they don't want to do also. So yeah, I think they're buying, like you said, the rarity coins, and that's really kind of, I've been buying gold and silver for a long time, and I think when I started watching your stuff, and then I started talking to ITM, really what I realized was, in my consulting career, I spent a lot of time helping multi-billion-dollar companies manage their risk. But I hadn't turned that back on myself. Right. So I knew that I had to get gold and silver, but I hadn't actually set out and said, how do I need to do this and what do I need to look at? And when we started looking at all the risks, the confiscation risk and the ability to have gold that holds value over time, I basically had to revalue how I was buying the gold and the silver. So I had mining shares, and I have no problem with the miners. I think we need to support the miners.
I agree with that.
Because they produce the gold and the silver. But if there's risk in that mining share, then I don't necessarily want to hold it right now. So
right now, and that's the key in a lot of this stuff.
Yeah. So I had basically moved out a lot of my mining shares, even though I do still support the miners, and I moved out a lot of my bullion and moved into these type of products which address that risk. And it's all about risk management. You cannot predict the future, but what you can do is assess your risk and say, what are those risks and how do I mitigate those risks?
Exactly.
And so what you're talking about is getting into a certain type of product which has a lot more risk avoidance in the event that there's going to be this demand for gold, which we know there's going to be because we're looking at this worldwide currency crisis that's coming up. So a lot of people will tell you, don't go into that type of coin. Just buy the bullion. It's cheaper and it's a way for people to get into it. But you're not addressing that potential confiscation risk. And I think there is, however, for people who don't have a lot of money and may not be able to afford some of those rare coins, there's another way to get into the precious metals, and that may be silver. So maybe you could talk a little bit about silver and the value it brings to people who aren't starting off with a lot of money to invest.
Absolutely. Well, unlike gold, silver does get used up in manufacturing. So there's less and less and less of it that's available out there. So that's definitely a plus for silver. It has properties that they can't duplicate. Historically, the relationship to gold and silver, because gold is the primary currency metal, and some people have a problem when I say that, but that's what they reset the currencies against. So that's why for me, and it's indestructible. So it meets all the criteria. That's why I say it's the primary currency metal. Silver is the secondary currency metal. Yes. So a big key is in the demand. There's always demand for physical gold and silver. There is not always demand for fiat and fiat products, especially when the currency loses all of its value. But because silver is something like 1470 or something like that, I mean, a dime or a smaller piece is 1/10 of an ounce. I mean, there's always a way for people at any level to afford this. Silver, gold in any form is monetary at its base. Yeah. So if you have sterling silver chopsticks, which I happen to have some sterling silver chopsticks.
Oh, wow.
I used to accumulate it. I'd go to estate sales and yard sales. And back in the day when I was really accumulating a lot of it, people go, well, I don't want to polish it. I'll polish it. Give it to me, and you buy it for nothing. But silver is great for people that are on a very limited budget, though you can also do fractional or less than an ounce of the gold and accumulate that way too.
Let's talk about that for a minute, because that's something that I did as well, because one of my concerns was if I just invest in the high end of the market and I have some debt obligations like my mortgage that I have to protect, I want something that's maybe a little bit easier to, had a little bit less of a premium. It's easier to get in and out of.
Well, we should talk about that, because
Yeah.
I know that that's a concern for a lot of people, the premium.
Yes.
And of course, I'm just looking at one end of the market, like to take care of your mortgage or something like that, right?
Right.
If you go to the lower ends, I mean, right now, and correct me if I'm wrong, because I don't really work in there so much, but you're going to pay what, 20? You can get some coins as cheap as like $2,000, 2,200, something like that. All right. So the fundamental value of an ounce of gold to reset the currency is at 10,000. What premium are you paying if you're paying $2,200?
You're not really paying a premium at all.
Voila.
You're still getting a discount, so it doesn't really matter.
What if I'm right?
Yeah.
What if I'm wrong?
Right.
Right? So personally, I'm not saying that I never have, because for the part of my portfolio, and it always does depend on what you're trying to accomplish, and that's what should drive what metals and in what form you put them in.
Yes.
But for the part of my portfolio that I have for my grandchildren and great-grandchildren, so my dynastic wealth, then I might go above fundamental value to buy a coin. Okay? But you can get them at such a cheap value that, in terms of fiat, so it's already undervalued. It's the most undervalued asset class, and you're buying it with something that's going down in value.
And it's rare,
Hello.
which builds value, because it's rare. They're not printing any more of these types of coins.
Exactly.
So there's going to be more demand for these at a point in time in which there is supply. And so that's going to drive the price up of that as well. And that's why
the premium.
That's why you keep the premium up even in times of currency risk. It's going to maintain that premium over time because there's going to be that demand for it.
Voila.
Yep.
And now, especially if you have the only kind of gold, if they do an overt confiscation, and you now have the only kind of gold that you actually can legally hold privately,
yes,
and actually legally use in the normal marketplace, which is really what I want, because I'm executing a strategy.
right.
Right? And by the time we're on the whole other side of this mess, I want to have, I'm going to guarantee my income for the rest of my life. And for me, more important than that, frankly, is that I'll have a legacy to leave my heirs. Because I kind of like to think that I'm going to have the ability to educate my grandchildren's grandchildren. Now, that may not be, I'm not going to know about that necessarily, but.
The important thing to add to that is you're doing it in an asset which, like you said, doesn't have counterparty risk. Unlike real estate, which has taxes, has eminent domain, has municipal codes, and things like that.
And you can't put it on your back and move it.
That's right. So if you have real estate and you can't sell it, you're stuck with it, and you have to maintain it and pay those taxes, even though you may not want to be there anymore.
Right.
But if you have gold and silver, it's portable. In whatever format you have, it's portable.
Exactly.
And it doesn't have counterparty risk. It's not a derivative. It's not something that's going to magically lose value.
And no matter where you go, you can convert it and have the same level of purchasing power wherever you go. That's pretty huge.
Yes, it is. One other thing I wanted to mention real quick before we wrap up is in the production of gold and silver, silver is trading at about the level that the primary silver miners around the world can produce it. So from a demand perspective, because silver is used so much industrial, it's used in solar panels, it's used in medicine, it's used in every electronic pretty much in the world, and it has properties that cannot be reproduced with any other element, on the periodic table.
Exactly.
Silver probably is one of the biggest bargains because it literally can't go below its current price, because if it does, then there's supply destruction and mines start shutting down, and then we don't have it, and then of course the price goes back up. Gold is almost at that level. The major miners in the world are not able to find big gold deposits anymore.
We've hit peak gold.
We've hit peak gold production, and so what's happening is the costs are slowly creeping up while we've been range trading this price in actual gold. So a lot of the risk in buying gold, no matter what product you buy, some
It's
people
gone. Yeah.
some people have said gold's going to go down to 450, because they're looking at the derivative chart.
Exactly.
They're looking at the paper, which is disengaged from the fundamentals. But when you look at the fundamentals in production costs, gold doesn't have a lot of room to fall either. So you're looking at things that are priced at their production value. So if you could go out today and buy a car for its actual production value and not pay a premium, you would do that, right? Because that saves you a lot of money. And that's exactly where gold and silver are right now. And I know this because I interview with a lot of mining execs. I do gold mining tours. I've done a lot of research on the gold and silver price. There is not a cheaper time really to buy gold and silver in its form. And even the premiums, like you said, for some of those coins are even really cheap. So you're not really taking a lot of risk.
I don't personally, I don't think I'm taking any risk at all. I think I'm taking more risk by staying in fiat. Though that's still our tool of barter.
Yes.
If I didn't have to use that as my tool of barter, I wouldn't have any of it. Right. Because I know that it's going to zero. Yes. And so even if, and I agree with you that we will see another melt up in these markets, that will be like the final hurrah, but I don't even know. I mean, this liquidity thing really has me in a spike in volume. We are living through, I think, the most interesting time in history that we could possibly be living through.
I agree with you. Well, it's interesting. It's interesting as long as you're not a victim of it, and so definitely preparing helps you to be able to kind of step back and look at it. And we do that because we analyze it every day. But definitely, this is going to have a very real impact on people. And so that's one of the reasons why I want to come out and visit with you, because I think a lot of what you do really speaks to helping people deal with what's coming. And I really do appreciate what you're doing. I also wanted to point out
I use a lot of your work, so I appreciate what you're doing.
Well, good. Glad we could share. And
absolutely. That's what the community is about, isn't it?
That's what it's about. It's about helping each other out. I wanted to state that when I worked for Ernst & Young and KPMG and I was doing these consulting engagements, they weren't free. And so when we were helping these companies do these big projects, there was always a price tag associated with it. A lot of what you do and the information you're putting out, there's no price tag. You're sharing that with the market. Right. But in my opinion, the quality of the research you do is on level with anything that we did at the consulting company level. So I just wanted to thank you very much and appreciate you for doing that. You do have, however, an opportunity coming up for accredited investors if they want to get in touch with you and see some of the additional new research that you're doing. Can you talk a little bit about that?
Absolutely. That's coming up the first weekend in February, and it's actually a full weekend workshop. And we're doing it with just a very small group of people so that we can have as much hands-on and one-on-one as we need to. Okay. It is without a doubt the most comprehensive piece that I've ever done on the strategy. And so the goal of that weekend workshop is that by the time you leave, you have your strategy in place. And because of where we are in this trend cycle, the timing couldn't be more critical.
It's the disappearing base of buyers.
Exactly.
It's that volume issue you're talking about. So
exactly.
Kind of ending up maybe the interview, if you could just chat a little bit about that and where you think we may be heading in 2019, not putting any dates on anything, but where do you see us going in 2019 and how much time do you think people have to do their preparations before we start to see this market crisis and the currency crisis really kick in?
Well, I hate to say it. I think we'll see the market crisis kick in before the currency crisis. Right, okay, and that could already be playing out. One thing that I'm going to take a look at for next week is there seems to be people are now starting to get nervous about the volatility in the market, and they're starting to leave the markets. They're going out of the frying pan into the fire and money markets. So I'm going to do something on that next week.
Right.
But what's going to ultimately happen, and I think we'll see this in 19, is if they can't get these markets to shift back up and calm down, then there'll be some forced sales. And so 2019, I think we're going to see an awful lot of volatility. I think the window of opportunity to get into gold and silver at these price levels is going to be changing pretty dramatically as more people wake up to, they thought Bitcoin was going to be the savior and then the new gold and they could just run to Bitcoin. There is no substitute for physical gold and silver. So, And we cannot forget that by the end of 2020, every single contract that is tied to the IBORs, the interbank offer rate, must be reset. And they've still got to finish creating those new products, creating a market, structuring and resetting all of those contracts that mature after that time. And they can't do it. Because even if they pull all of that off absolutely successfully, and, what are the chances of that besides none? I mean, seriously, none. That's still going to change the valuation of all the contracts that are held in the banking system. Bail in anyone? I think we could see, I hate to say this, but I think we're going to see some bail-ins next year.
That may be one of the most extremely important points that you just had for people that are watching. The laws around the bail-in and the laws around the reset are already being put into place.
Oh, they're already well into place.
Yeah.
And, it goes back to the risk transfer thing. A lot of these leveraged loans, a lot of the debt have been put in with covenant lights, which means removing protections from those that are, the individuals, not the banks that do the lending, but the individuals that buy those products. They don't have very many protections in them. Even a lot of the new stock, like Facebook, I think I don't know if they were absolutely the first stock that did it, but I think they are, where shareholders really have no vote. They have no voice. They have no say. So, a lot of and there have been many others. So bail in anyone. I hate to say this, but I think we could see a ratchet up of bail-in. And our time is very, very narrow.
Yeah.
So the sooner you get in place, the better off you are.
I absolutely agree. And when you see that infrastructure start to be put into place by the sovereigns and by the banks, when they start to put that in place, that's when you want to get out of the system. That's your last warning, warning bell before something could happen. Yeah. And so definitely in this time period that you're talking about, you definitely want to make your move now.
Right. And the other thing I want to bring out is in May of 2017, China's yield curve inverted. So the shorter term rates went above. In the Eurozone, they have essentially a flat yield curve, and our yield curve, even though they keep talking about it going to invert, no, it's inverted. That's according to their data. So, that there's a global slowdown to pay all of this mountain of debt and all these leveraged loans. Get your gold and silver, get your plan in place.
Yes.
Please, just get ready. Then, I feel like I'm probably more ready than almost anybody that I know, and I still don't feel fully ready.
Yes. I agree with you. It's like, how do you ever stop,
You never do. Ready? You're going to see.
But at least if you put a plan in place, you assess your risk, you develop a strategy, you work towards that strategy, that gives you the best chance of surviving through. And then, and it's well transferred to your kids, but it's also survival in a certain aspect, keeping your quality of life.
Absolutely. Yeah. Absolutely. So, and then whenever it becomes apparent to the world, because it's already unfolding, this isn't something we're waiting for. Right. It's something that's already taking place. But when everybody knows that it's taking place, okay, well, I'm ready. I can feed a lot of people. I have, I'll be able to pay my property taxes. I'll be able to pay off the mortgage. I'll be able to take care of my children and my grandchildren and a lot of strangers. A lot of people I don't even know yet that are going to need some help.
Yeah. So we'll do this in a maybe a separate conversation, but I'm going to go out and visit your place and look at some of the preparations you had. So if anybody's interested, just contact me and I'll have some more information on what Lynette has done outside of the interview for Seeking Alpha.
Right, because it's food, water, energy security, community, barterability, and wealth preservation. That's the mantra. That and shields are made of metal, not paper or promises.
Or derivatives.
No, shields are not made. Shields are not made of, how do you get out of derivatives? The whole system is now integrated throughout. Everybody's going to be impacted. Yeah. The question becomes, a small group of people are actually going to thrive through this and come out the other side fiscally better than when they entered. I want to be in that group. I want you to be in that group.
That's right. And that's
You
why
know,
we share
that's
the
what we
information
want.
that we share.
Exactly.
Well, Lynette, thank you so much. I really appreciate the time you've given. This has been great. So,
Oh, I appreciate you coming down here. It's so
Yeah.
much nicer to do an
Yeah,
interview
absolutely.
in person than, than on the phone or Skyping. Not that that isn't wonderful too, but it's just a different energy.
No, I love it and love the Phoenix area as well. Been through here several times. Lots of gold mines in this area. A lot of history around gold
Yes.
and silver in this area. So if you're a fan of gold and silver, Phoenix is a good place to be. So
It is.
I'm enjoying my time down here. So
Good.
thank you very much. I appreciate it.
My
and
pleasure.
We'll talk again.
Bye-bye.